Guys, it's here. Stagflation is here. I talked about this 8 months ago on my channel that stagflation would be a major 2022 investment theme. And now Ray Dalio is saying that stagflation is very likely because the Fed is failing to drive the markets and economy like a good driver drives a car. In today's video, we're going to talk about his views on the US, on Europe, and on China. We'll talk about his recent extraordinary investment outperformance relative to the broader markets, how to approach a stagflationary investment environment, and of course, a brief review of our markets and our strategy. If you're new to my channel, my name is Larry. I cover US and China macro. If you're interested in the subject, subscribe, turn on the bell, and if you enjoy the research, hit that like button. Let's get started. Now, before we jump into the content, I want you to join my public email list. You can see here over the last 30 days, more and more people are reading my research. I send out one high quality email every single week to my public audience to share my opinion on where I think markets are going next. And also follow me on Twitter because I only have time to make one YouTube video per week and I'm able to tweet more throughout the day. Now, before we start this video, let me know in the comments below if you think inflation CPI is going to keep going up or fall from here in the second half of 2022, because that's going to drive everything from here on out. So we're going to be talking about Ray Dalio, his views on markets, and specifically his views on stagflation. Now, Ray Dalio, he joins market bear Jeremy Grantham in discussing the end of the stock market bubble. So Ray Dalio and Jeremy have been very correct about calling the bubble popping, and their warnings were not really heeded in 2021, but they've played out to fruition, just like how Michael Burry's predictions have come to fruition as well. Now, with macro back in fashion, Ray Dalio's Bridgewater fund strategy is outperforming big time. But for those of us who are not familiar with hedge funds, I want to give you a quick overview. Now, according to the CFA 2022 refresher materials that I have access to, there are 6 to 7 types of hedge fund strategies, depending on the classification service that you're looking at. And if we look at the Hedge Fund Research Association, or the Eureka Hedge Fund Association, there's 6 to 7, 8, 9 different classification sources. And you can see here that macro is one of them, okay? In both lists, macro is one of them, and that is Bridgewater's primary investment thesis. Now, Ray Dalio has been building a very large short position against European stocks because he doesn't like the economic outlook in the region and because of the geopolitical turmoil happening between Russia and Ukraine. Now, for those of us who are not familiar with the European stock market, here is what most investors look at for a main index. It's the Euro Stoxx 50. So if you're my friend from Asia Pacific or the US, this is the index that Ray Dalio is placing a lot of his short bets on. And to dive a little bit deeper, you can see that these are the 10 largest components inside the Stoxx 50. Most of these companies are based in either Germany or France. And the largest company here is ASML, which is a large tech company in the semiconductor space. And the second largest is LVMH, which, as you know, is a large conglomerate based in Europe. So not only does Dalio have short positions, he's actually increasing his short positions in Europe lately. And that's notable because Europe has actually fallen quite a bit since the beginning of the year. And for him to up his short position means that his conviction is that the Eurozone's economic woes are probably going to continue. And his macro views have rewarded him handsomely. Macro as a strategy has performed well this year, but his fund has performed especially well, gaining 32% in the first half of the year, whereas you know the NASDAQ and the S&P 500 have had a very tough time. Even China is not doing as great as Bridgewater's performance. Now let's talk about Bridgewater's investment strategy. Most people don't know how they approach markets, and I want to share with you how their process looks like. Like I said, Bridgewater is a global macro investment manager. So they make bets on where they see the economy going. They make forecasts on interest rates. They make bets on Fed policy. And Bridgewater, back in 2021, they created what was called a proprietary bubble index. And this is all on their website if you want to take a look at it. And what this index measures is 6 different criteria that Ray Dalio himself put together in order to understand whether the market was overvalued or undervalued. And in 2021, his conclusion was that many parts of the market, especially in emerging tech, was very bubble territory, bubblicious territory, frothy territory. Now we can see here that Ray Dalio's model ended up being correct. The blue curve here indicated how expensive the markets were relative to its history, and it was very elevated according to his model, and it ended up being a very accurate indicator of the bubble popping in the next several months. And that's exactly what's happened in 2022. So then what is Ray Dalio's outlook? Well, he believes that in the new world changing order, that China is going to be a major beneficiary. And he talked about this in one of his books called The Changing World Order. Speaking of China, now I want to take a moment to talk about our sponsor today, Baidu, one of the legendary BAT companies of China, for partnering with this video. They commented on the high quality investment research that I published on my channel, and I'm proud to tell you about an awesome event that they are hosting to the general public soon. On July 20th in the US, 9 p.m. Eastern Standard Time and 6 p.m. Pacific Time, Baidu will be hosting its Baidu World 2022 event, and the event will showcase the release of several of the company's products in intelligent cloud, automated driving, and other AI initiatives. As a brief history of what they've done in the past, in 2020, Baidu showcased fully autonomous driving with their 5G remote driving service. In 2021, they unveiled the concept of a robocar and a 7-nanometer AI chip, and this year, in 2022, they're talking about the advancements in the products they are releasing in autonomous driving. They'll also announce another major cooperation with China's Aerospace Science and Technology Corporation. This will help them explore aerospace technology and artificial intelligence further. In China, the top 4 cloud players are Baidu Cloud, Alibaba Cloud, Huawei Cloud, and Tencent Cloud. Baidu's AI Cloud, as of Q1 2022, has a market share of 8.4% and has grown at twice the industry growth rate. Baidu's AI Cloud now powers wind plants in the Guangdong province and water storage operations in Guangzhou. The show is going to be led by a digital avatar, in other words, a digital host. The AI digital avatar's name is Shi Jiajia, and she will be the host of this year's event. This event is a great way to get up to speed on the AI and cloud market in China from a sector industry level, and more specifically at a company-specific level to understand Baidu's plans. These events, in my opinion, are great events for fundamental equity investors to assess a company's outlook and future corporate strategy. If you want to attend this event, which is open to the public, simply put your email address below and you'll get more info. Once again, thank you to Baidu for putting a stamp of approval on my channel's research quality. And now back to the video. So now that we know that Ray Dalio says that stagflation is coming, how do we prepare for the investment landscape that lies ahead? Well, first, let me define for you what stagflation is, just as a general refresher. Stagflation is the mix of uncomfortably high inflation, rising rates, and stalled economic growth. If you think about the landscape that we're in today, that definitely meets every single criteria for stagflation. And the problem during stagflation is that both stocks and bonds fall together. That is one of the main things that happens in stagflation. No asset classes really work. Commodities struggle, bonds struggle, real estate struggle, stocks struggle, and of course, digital currencies struggle as well. And I talked about this last year on my channel. Now, how do we approach stagflation investing then? Here are some bullet points that I believe will give you some high-level guidance. You want to identify investments that are likely to be insulated against the effects of rising inflation and slowing economic growth. In other words, you want to find companies that have very stable gross margins and also stable growth metrics relative to their peers in this environment. Also, you want to understand which sectors or investments have the best odds of outperforming during a downturn. There are sectors in the S&P 500 that are more cyclical than others, and as I'll show you in a second, Ray Dalio has positioned his portfolio in a way that is very likely going to withstand stagflation quite well. And of course, diversification is going to remain quite key. From a quote on Twitter, Ray Dalio says that in bad times, your goal might be to keep what you have, to minimize your rate of loss, or simply to deal with a loss that is irrevocable. Your mission is to always make the best possible choices, knowing that you will be rewarded if you do. So let's now talk about what Ray Dalio owns in his 13F portfolio at Bridgewater. And for those of us who don't know what a 13F portfolio is, it is an SEC form that is a quarterly report that is required to be filed by all institutional investment managers with at least 100 million in assets under management. Now, if we take a look at his top 3 individual stock positions, they're P&G, Procter & Gamble, Alibaba, and Johnson & Johnson. And together they add up to roughly 11% of the portfolio. And we can see in the slide here that Ray Dalio's 13F portfolio has a lot of very high quality ETFs that track the emerging markets in Europe and also the SPY. On top of this, if we look at some of the single name companies that he holds, Procter & Gamble, Alibaba, Johnson & Johnson, Coca-Cola, PepsiCo, Costco, and Walmart, he's positioned very defensively. But at the same time, these companies have great growth potential when the economy swings back as well. So his portfolio is positioned in a way that is going to definitely weather the stagflationary storm that he sees coming in the next several months. And here's what we've been doing inside my investment community. My analyst team and I, we've been using stock screens within YCharts to begin screening for opportunity. And we're going to navigate this turmoil by understanding what types of sectors, themes, names specifically, are starting to change their behavior as inflation data comes out, as job data comes out. We want to be the first group of people to understand where the markets are going next. And so my analyst team and I are working very hard to figure out where is the best position to be in as we approach the second half of this year. Now let's talk about Ray Dalio's collective macro views on the US, Europe, and China. And Ray Dalio has a pretty bearish view on the US. Not only does he say the US and globally is in a period of stagflation, he also believes that the US is headed towards civil war. And he believes that because there's a wealth and values gap combined with the country's structural economic woes. And this will fuel internal conflict. That's what he believes. And for Europe, we already know what his view on Europe is. He is shorting $7 billion of European stocks. And that doesn't necessarily convey a very positive opinion on that region to me. Now, what about China? Well, during the storm that we saw earlier this year, the regulatory storm, the peak fear when it came to zero COVID, back in February, Ray Dalio was boosting his bets on China. Once again, if we think back to what has happened, big money wins yet again. I mean, I was trying to tell you guys on my channel that China was going to make a big comeback. And unfortunately, nobody really listened to me. I mean, of course, my videos got a lot of great traction, as you can see here, but more or less, there was a lot more fear and panic than rationale at the time. But it's okay. Like I said in one of my previous videos, I will do my best to help you catch the next wave, but I will ask you for your patience, and I will ask you to be a long-term investor, because if you are patient, I will be able to help you. So let's talk about his views on China. What's his research process on China? And their process in China is to understand the country on a very local level. So, unlike a lot of hedge funds that have opinions on China without actually having a presence there, Bridgewater has many offices in China, Beijing, Shanghai, okay? And because they've got boots on the ground there, they really do understand the local political climate. So, truth be told, one of the main reasons I was quite bullish on China back earlier this year, of course, I did my own macro research and I did my own fundamental research, but I also did believe Ray Dalio's positive thesis on China. So that was one of my rationales for staying long in this space. Now, I know that there are a lot of people who are worried about Chinese ADR delisting because of US Sino tensions. Once again, as a reminder, Interactive Brokers allows people to buy Hong Kong listed shares, link in the description below. Okay. Now, my friends, there will be many powerful opportunities in the coming months. Investors who are willing to think long term will be rewarded. This is the time to do your homework and be proactive. This is not the time to be passive. It is important to form your own opinions and not let narratives dictate your sentiment. So lately, as we can see on Google, there's a large search volume on why are Chinese stocks rallying? And there's an explanation for this. Easing virus restrictions and a looser policy stance have helped Chinese equities defy the recent sell-off of global stocks. I talked about this earlier this year. It's just that my thinking was not yet validated on headlines from Barron's and Bloomberg. But as you know, by the time that my opinions are validated on headlines, it's probably, I don't want to say too late, but the easy money has been made. You want to have a very strong opinion before it shows up on the news. And so let me show you what I did in July for our investment community. Going into July, on July 1st, I published monthly slide decks of asset class opinions. And going into July, my opinion was that Chinese internet is actually a hold / approaching risk reduction. So in early July, you saw a lot of media outlets like Bloomberg, CNBC, Barron's talk about their bullish views on China, but that's after Alibaba had already rallied 50 to 70%. So going into July, I was actually telling our members that you should not be chasing this rally. And the reason I come to these conclusions is I follow the fundamentals, the technicals, the valuation of the names in my coverage universe. You can see here YCharts is an amazing resource, all right? And because of this, I use objective data to form my opinions. And you can see what I wrote in my July report. I said technicals for the Chinese internet trade are approaching the upper end of the RSI range. And while fundamentals still look favorable for long-term investing, in the short term, the easy money has been made. So members who are reading my thoughts and research carefully would have avoided chasing Alibaba north of 125 per share. Because as you know, there was recent regulation news that made Alibaba retrace about 10, 12%. And if people were listening to media outlets, they potentially could have gotten trapped. That's what happens to retail every single time. And the purpose of my channel is to provide that high quality, objective research to ensure that that doesn't happen to you. I do my best. I'm not always going to be right, but I will do my best by sharing with you as many objective observations as I can. So in one of my latest emails, I'm very happy to say that not only do I have a lot of really wonderful friends, members from the US in my Patreon community, I've also got a lot of European friends and friends from Asia Pacific as well. So I've got one member here. His name is, we can call him Aristotle. He's from Cyprus. And I just want to show you about how he thinks about our community, his experience so far. So let's take a moment to listen to what he has to say. And it's that every community is different. My community attracts a certain type of investor. What would you say, Aristotle, is the ideal type of person who would enjoy my community? Because as you know, we do not do day trading, we do not do scalping or short-term stuff. Can you describe what type of person would enjoy our community and benefit the most?
From my experience, I've been investing and researching the markets for over 3-4 years. I believe the person who fits your community and would benefit out of the most of it and would stick around will be someone like this. So someone who's been around in the investment industry and the markets for a while. So they made a lot of mistakes. They learned and they want to keep learning. So they're looking for information which is crystallized, it's well researched, and they can get the most of it in a simple manner, in a short and quick way, and they will definitely appreciate the work you're doing.
Perfect. Awesome. My last question for you is, as you know, our community made a pretty big macro call in the first half of this year, being long China, which was very contrarian, as you know, and subject to intense public skepticism. Was there any of our macro strategy or research that helped you stay confident in your own positioning and helped you to navigate this challenging market environment?
Yeah, for sure. I mean, it felt almost counterintuitive because all the noise from everyone, institutional investors, investment banks, etc., was, I mean, against it. And somebody wanted some clarity and you provided the clarity. Oh, it felt a bit uncomfortable to go against the tide, but you explained things and you provided a reasoning behind your strategy. So I mean, I acted on some of it and benefited from it so far. So, I think it will benefit me for longer.
I'm really happy to hear that. Well, Aristotle, I continue to look forward to providing the best quality research to you and our community. And once again, thank you. Thank you for being an awesome member.
You're welcome. Thank you, Larry, for everything.
All right, guys, in my opinion, we are approaching this multi-month period where peak inflation may hover near a local top if oil can stay underneath that 105 barrel level, and it could begin a slow descent from very stubborn highs. So there are implications behind this type of environment, and being either too defensive or too aggressive at the wrong time will be costly. So once again, I continue to believe that the next 6 to 12 months is one where if you've got cash, this is potentially a time where you will be able to find companies, great companies at very favorable levels if you have the proper strategy. So once again, let me know your thoughts in the comments below, whether you think inflation is near a top or whether this is just the beginning stages of even higher inflation. Well, guys, much love as always. Thank you to Baidu for sponsoring today's video. Make sure to be on my public email list, and I will see you guys in my next video.